In today's volatile and complex business environment, organizations face numerous uncertainties that can disrupt operations and derail financial control efforts. This module explores the intersection of strategic risk management and business continuity planning as they relate to cost accounting and budgetary control systems. It provides you with an in-depth understanding of how to proactively identify, assess, mitigate, and monitor cost-related risks while ensuring operational resilience and financial sustainability. Strategic risk management in cost control focuses on anticipating internal and external threats to the budgeting, costing, and resource allocation systems of a business. It is tightly integrated with business continuity, which ensures that in the face of disruptions, e.g., economic downturns, cyber attacks, inflation, supply chain breakdowns, cost control mechanisms remain intact, and the organization survives and thrives. By the end of this module, you will be able to understand the nature and types of risks affecting cost control, integrate risk assessment into cost accounting systems, apply strategic frameworks to manage cost-related risks, design business continuity strategies that safeguard financial and operational systems, develop contingency budgeting and risk-sensitive cost control policies, evaluate the effectiveness of risk responses in real-time cost environments, understanding strategic risks in cost control. Strategic risks refer to long-term, high-level uncertainties that threaten an organization's ability to achieve its financial and operational goals. These risks are interconnected with cost behaviors, budgeting frameworks, and decision-making processes. Common strategic risks. 1. Economic instability, inflation, recession, currency fluctuation. 2. Technological disruption, automation, obsolete costing systems. 3. Political, regulatory changes, tax laws, tariffs, minimum wage policies. 4. Operational inefficiencies, poor forecasting, wastage, cost overrun. 5. Supply chain vulnerabilities, raw material shortages, logistics disruption. 6. Cybersecurity risks, financial data breaches, accounting software sabotage. Risk identification in cost systems. Effective risk management begins with the early identification of threats to the cost control architecture. This involves examining internal processes and external environments to pinpoint potential weaknesses. Risk indicators. Unexpected cost variances, frequent budget revisions, delayed financial reporting, supplier unreliability, rapid cost inflation in materials, labor, breakdown in communication across cost centers. Risk assessment and quantification. Risk assessment requires measuring likelihood and impact of cost-related risks. This can be done using qualitative matrices or quantitative techniques like sensitivity analysis, cost projections under varying scenarios, Monte Carlo simulations, probabilistic modeling of budgets, risk-adjusted budgeting, allocating reserves for uncertainties, scenario planning, best case, worst case cost scenarios. Example, period. What if the cost of raw materials increases by 25%? How would it affect our contribution margin and break-even point? Strategic risk mitigation techniques. Mitigation involves developing cost control mechanisms that are resilient under varying conditions. Key techniques. 1. Flexible budgeting. Adjusts for volume cost changes in real time. 2nd, activity-based costing. ABC. Offers better cost accuracy for complex operations. 3. Zero-based budgeting. ZBB. Forces justification of all costs from zero. 5. Cost buffering. Allocating contingency funds for unpredictable costs. 5. Cost sharing. Transferring risks to partners, insurance, or government programs. Business continuity planning, BCP, in cost control. Business continuity planning ensures that cost control and financial systems remain operational during and after crises. BCP components in cost accounting. 1. Critical process identification, payroll, procurement, reporting. 2nd, data backup and cloud accounting, safeguarding financial records. 3. Emergency budget models, quick deployment of funds for essentials. 4. Succession planning for cost managers, ensuring cost leadership continuity. Fifth, interim KPIs, new metrics for crisis scenarios, e.g., burn rate, liquidity ratio. Integrating cost risk into strategic planning. For long-term sustainability, businesses must build cost control into strategic planning through cost risk alignment with organizational goals, enterprise risk management, frameworks, cross-functional budgeting teams, dashboards with real-time risk indicators, audit trails and compliance checkpoints. Case study, COVID-19 impact on cost structures. The pandemic revealed critical weaknesses in static budgeting systems and over-reliance on traditional cost models. Organizations that used flexible budgeting, implemented cost prioritization matrices, shifted to remote, cloud-based accounting systems, built resilience funds, were better equipped to sustain operations and recalibrate their cost baselines. Challenges in strategic risk management for cost control. Data complexity. Real-time risk data requires advanced analytics. Behavioral biases, resistance to change, optimism bias, lack of integration, risk managers and cost accountants working in silos. Over-control. Excessive cost-cutting can harm innovation. Key takeaways. Strategic risk management is no longer optional in cost control, it is essential. Forward-looking cost systems are more valuable than reactive ones. Business continuity planning must include budgetary and financial dimensions. Risk-aware cost control leads to agility, adaptability, and financial resilience.